Oh, okay. Now the recording is started. Okay. So let me just repeat. The whole corporation is about raising the capital from somewhere and invest it into more profitable investment projects. So, and the intrinsic value are the value of the securities. So how does that link into the corporation? Well, here what we're talking about in normal sense, the securities, we're talking about maybe stocks, and the stocks are a share of the corporation's equity. And we're going to understand and look at the equity in just one moment. But here, just think about it as a share of the whole corporation. So if the corporation is having a higher intrinsic value, then apparently each share of stocks will be more valuable. So we try to determine the intrinsic value for the whole firm so that we can have a good estimate of the firm's stock. Okay. The intrinsic value, on the other hand, all start with how you are going to discount the cash flow that you're going to get from that corporation. So that's the valuation formula for everything. So here we assume that the firm is going to raise be from operation to generate a bunch of things. So it could be a bunch of, say, profits, could be a bunch of net income or free cash flow, for example, in this case, and it could be a couple of other measures. But in here, if we're looking at the whole firm value, we say that eventually the firms are going to generate free cash flow. And we're going to talk about the concept and how to calculate free cash flow later. So think about, for now, the free cash flow is just talking about how much of a cash flow that is totally to the manager's discretion. So think about the disposable income at your household, right? So everybody earn an income. I earn a paycheck every month, but not the whole paycheck can be squandered into a vacation or something. So a big part of it will have to pay my bills, utilities, mortgage, and have to pay some food to sustain myself, all that nice things. And then there was a small part that's really to my discretion, like a very small part that I can go out and have some nice lunch or something. Okay, that is the part that we are talking about. That's more like the cream of the top, if you will. Okay, so that's what we call the free cash flow to a corporation. So a corporation generates a bunch of free cash flow, and eventually it is this part of free cash flow that they have the right to either dispose and give it back to the investor, or they can reinvest into the future projects and things like that. Okay, so then we are going to take those, that's the kind of the resource that everybody eventually are able to generate. Take that, put it into a forecast for the future, that how much of free cash flow that you can generate, discounted by the cost of capital. Here we give it a more complicated name called the weighted average cost of capital. We're going to talk about that in very detail later over the semester. But for now, just think about it is a mix of how much will be the cost of the debt and how much will be the cost of equity. So apparently, if you use the cost of capital to discount it, you'll be able to generate some kind of value. Okay, this is the basic thinking idea of it. I know it looks a little bit different. If you have some finance background, you probably know the dividend discount model. Here it is not the dividend, and this is not discounted by the equity rate, but the fundamental idea of formulating this whole thing is the same. So forecast a bunch of things that you're going to get in the future, and you are going to discount it using a certain appropriate discount rate. Okay, so now I just realized that I probably talk a little faster than usual. If any of you feel that I'm talking too fast and want me to come back a little bit, uh, please feel free to just yell or chat. Somehow let me know so I can feel free to like relax a little bit. Okay, this whole thing is because now after I ask all of you to mute up your mic, and then it becomes so silent that I feel like I have to talk faster than usual. That's the side effect. Okay, so let's move on and look at all the three financial statements. So income statement, we can next look at the balance sheet, and then we're going to talk about the statement of cash flows. So income statement, first of all, how many of you are not very familiar? Let's see, how many of you are not very familiar with all these financial statements? I know many of you are having accounting background, so could those of you who don't have any background in the accounting and haven't seen a proper financial statement before, can you raise your hand? Whoa, nobody. Nobody raised hand. What does that mean? Means everybody has learned it before? Should I still talk about it? Yeah? Okay, in the accounting class. I mean, get it stand into some kind of, as long as you have seen an income statement before. Hey, people, everybody talk to me. Chat with me. Say yes or no. Okay. I feel like so nervous when everybody is silent. No one? Nobody? Really? Oh, managerial accounting. That's good.
I'm very familiar with it with my work and past history.
Yes, very good. Okay. Okay. I've seen the statements before. Okay. Five of you have confirmed. And how about the others? Okay, I've seen them. Jessica. Oh, okay. Cool. How about Naomi? Okay. Yes, Tracy. Okay. Oh yeah, Bao. I know you are pretty familiar with these statements. Yep. So a lot of you are actually working it, but a few of you did not confirm with me. Now I'm getting obnoxious because feels like okay. Let me not go that far. Yes, I know Brock. Okay. Should I ask all of you to turn on your video cam? Because I feel like anytime some of you are not talking, I'm like, did you went away to eat your breakfast or something? Okay, but let me not go that far. We will go on and see how much of my nerve can really tolerate. Okay, so since most of you have seen the accountant's income statement, now let's look at this income statement. Of course, it all starts with sales, or i.e. revenue. Don't ask me why sales is also equal to revenue. Why do they have two different names? Because people are crazy. They always want to talk in different words. Okay, so that's it. So sales is equal to revenue, in case it shows as revenue here. Okay, and that's always the starting line for income statement. Then you have cost of goods sold. What is cost of goods sold? Anybody? Can you turn on your microphone and tell everybody else? Oh, how do I make him work?
Actual cost of goods which we can subtract from revenue or sales.
I'm sorry. Wen has raised his hand. Oh, he's above me. That's why. Okay, so how do I? Okay, Wen, go ahead and talk.
Does cost of goods sold include labor or raw materials costs that are related to the production of the goods?
Can somebody else answer Wen's question? Wen's question is, does cost of goods sold includes the labor cost, or for example, utilities or other kind of operation cost?
Yes, raw
Yes.
material and other expenses.
Okay, okay, so that's a little different from what I understand it. I thought cost of goods sold includes the material, but it doesn't include, say, administrative costs and things like that. So, okay, so Tracy said, let's look at Tracy's message. Tracy said the cost of goods sold equal to direct labor costs plus material used to produce goods. Yes. Okay, so Tejas, go ahead.
Basically, material cost, labor cost, and any other related material cost.
Right. So basically, I think what I have in mind was whenever you talk about the labor cost, we're talking about the whole administrative thing. But here, I think the cost of goods sold includes the labor cost that's directly related to the production. And for people, say like CEOs retirement fund, that's probably not in cost of goods sold. Am I right? Do you agree? Okay, good. Thank you, Bao. So Bao confirmed that I am correct. So with cost of goods sold and, for example, the CEO's salary and their retirement fund should go into other expenses. That's the next line. Okay, that probably includes the utilities and all the funding to buy employees lunches and everything. So, and then we go on to depreciation. The depreciation is a hypothetical concept that really, well, does it really happen? Well, economically, it does happen, but there's no money going out from depreciation. Does that make sense to everyone? So basically, for cost of goods sold, for other expenses, most likely you have to pay cash. But for depreciation, there's no cash flow related. So it's basically talking about how much of the value is depreciating or like reducing over the time. And we're talking about facilities and other real productive capitals. Here, okay, let me not use the capital in two different sense. So in finance course, let's keep the word capital as a sense of money. And the depreciation is on those facilities or the fixed assets. So over the time, the fixed asset will lose their value because you cannot use a fixed asset forever. So after a while, they become obsolete. Either they're not useful to you anymore. Okay, either they are not functioning or they don't suit the kind of work you want them to do anymore. So for every fixed asset, you assign them an expiration date, kind of. Like your carton of milk in your refrigerator, everything has a date. So after you assign that date, you distribute the value that is going to reduce over the whole course towards every single period within that useful duration that you can actually use it. And here, when we're talking about annual concepts, then this will be annual depreciation. So basically, in 2012 here, this company has its fixed income, no, sorry, the fixed assets reduced its value for 18,900 thousands. I think here are, you see, I think it's in thousand or is it in millions? I think it's in thousands. Okay, so then after you have that depreciation, then the total operation cost is what is should be the cost of goods sold, the other expenses and depreciation all added together. Okay, I know there are some kind of some accounting standard that do it differently because accounting is a little bit customizable. So sum of total operation cost does not include the depreciation, but here when we talk about it, we put the depreciation as a part of the operational cost. So then the EBIT, the earnings before interest and tax, is literally EBIT. So you're going to take EBIT as the number before the interest expense, 62,500, and the taxes, 58,640. Okay, so that's the meaning of earnings before interest and tax, EBIT, the earnings before that. Okay, then of course after from EBIT we are going to expense the interest. After we expense the interest, we calculate the pre-tax earnings, calculate the tax, subtract from it, and you get the net income. Well, that is a bare bone kind of high level of an income statement. For people who actually work in the accounting industry, they will tell you that this is, I don't know, this has ignored a lot of or neglected a lot of details. And that is definitely true. Okay, and a lot of times, even financial analysts who are not an accountant, they look at the income statement, they have to dig a lot deeper. For example, sales, and you need to look at exactly from which project that you are having sales from, and expenses, same thing. Okay, so here what we are looking at is just a bare bone minimum kind of line item of everything in the income statement. Okay, and a couple of things to notice. First of all, before EBIT, it is everything that is related to operations. And after EBIT, there are things that are kind of out of their discretion or out of their hands in the short run, if you will. Does that make sense? Okay. So, yeah. After the interest expense, it can be changed if you over the time borrow less and less. But most of the borrowing are medium to longer term. Well, there are short-term borrowing. But the interest expense is not going to be immediately manipulatable. So you can't really change the interest expense most of the time. It cannot change it very, very quickly. And the tax, of course, it is what it is. You know, Uncle Sam always want to share. So that is the part is not related to their discretion, and that is the part that is not related to their ongoing main business. And that is why, arguably, a lot of people are saying is that before any kind of deduction, what kind of deduction you're talking about? Because we do have depreciation here, but you're talking about deduction from taxes. Okay, I see. So that will be related to, right, so that will be related to tax and how the taxes actually worked out. Here, we're kind of simplifying the whole structure and say that, of course, you are going to expense the interest before you get the pre-tax earnings. So in a sense, you're deducting the interest from whatever that's going towards the profit, right? And yeah, kind of. So that part is there, but of course there will be some other parts that we kind of don't care at this level. So where were I? Oh, I was saying that the focus of an income statement for a financial analyst is most of the time the part that is above EBIT. And that's why a lot of time EBIT, sometimes even EBITDA, okay, so earnings before interest, tax, and depreciation and amortization, and those are the focus of the financial analyst because it reflects the ongoing operational performance of the firm. So that is the part that reflects that's their scoreboard of their main business. Are they doing well? Are they not doing well? Are they generating consistent profit? Are they all of a sudden plummeting and really generating negative EBIT? And if that is the case, why so? Right? So sometimes even, for example, in 2013, even if the net income is negative, you can still see the EBIT is bare bone positive. It does get smaller, okay, but you can see definitely there will be a cutoff where they have to flow above the water of their interest expense and the taxes, if you will. If they don't keep that in the water, then they are what we call under the water, becomes negative. So in that case, then either the firm is not performing very well, which is very often the case. That's why the market will think about it very negatively. And second of all, it could be a temporary thing, which is the case that most of the CEO or CFO will try to make to the whole market and say, okay, yeah, it is negative, but it is temporary. Okay, so this is a kind of thing that you really have to use your judgment call and dig deeper and find out, is it an ongoing thing or is it a temporary thing? Is it a future bright? Is it future dim? Okay, so the way we look at the income statement is usually we don't look at it over 1 year. Well, income statement has a sense over 1 year. However, as a financial analyst, we are obsessed with numbers. So how can we be satisfied with like 1 year's data, right? We're like, okay, just had an appetizer of the whole dinner. You have to feed us more. So with that, you have to go back to historical data and try to project data in the future. So that's always the goal of the financial analyst, that you try to project it and try to forecast. Okay, so we look back and look between 2012 and 2013. What do you observe? Go ahead, Arjun.
I don't have any question.
Oh, okay. So anybody, I mean, just looking at 2012, 2013. Okay, go ahead, Tejas.
basically sales increase, but at the same time depreciation and total operation cost also increase. Overall, their net income is down for 2013.
Right. So sales increase. However, because the depreciation jump up big and other expenses also jump up big, so the EBIT actually dropped. Isn't that interesting? So you would thought that the revenue increases will be a good thing, but somehow they wind up having too much of cost of goods sold. And with other expenses and depreciation coming on the top of it, they actually have a less of EBIT. Now remember, the goal of sales is the increasing sales is whose goal? Okay, anybody from marketing background? Well, if you think about it, the whole marketing project, the goal of marketing is to make sure that the consumers are fitting right in their goal, and then they're marketing to the correct customers so that you are going to boost the sales, right? So in a sense, the marketing people care less about the cost. They look more on the sales. Okay. However, boosting the sales itself may or may not work if you have somehow a higher cost of goods sold. So what can you conjecture in this case? What kind of story you will make that kind of fit in the current trend? What do you think?
Well, the expenses went way up.
Yeah, the expense is way up and the cost of goods sold is way up. And why is that?
You can say that marketing used too much money as far as funds to market the product. So they got the numbers in, but they used too much expenses.
Right, they got the numbers up and they use too much expenses. Now here, is that should be included in the other expenses? So Nicholas is saying maybe they bought a lot of depreciable assets, so they bought a lot of fixed assets. Yeah, I think if you look at the other expenses, I think that should include the part that is about the marketing, right? So here, it doesn't look like, well, it has doubled or more than doubled.
The interest expense doubled.
Yeah, so the depreciation is more than double. It's like how many times? 6 times than before. So it's interesting. I mean, how can a company all of a sudden bring, maybe they have bought a lot of fixed asset. That could be true. Okay, and well, okay, let's leave the deeper questions for later, but let's just say that the marketing department went wrong. Yeah, it could be. It could be. I still think it's less from marketing than from the fixed assets. Because if you, I mean, again, marketing costs should be included in the other expenses. And the other expenses, yeah, it did increase a lot in numerical sense. Well, that is true as well. Okay, so like all the accounting stories, you can't really have a clean answer. And that is the kind of discussion and the kind of analyzing. Yeah, the purchasing department went wrong. That could be true because the cost of goods sold got so high, it's out of whack. But the sales also got above, so it could be some operational difficulty that because some urgency needs of the material, they have to buy the material in a higher cost. That's possible. But anyway, this is the kind of discussion that we will have over an income statement. Okay, so the question is really not about number 1, 2, 3, 4, comma 3 or 400, or the numbers, but the question is really, oh, where's the increasing? Where's the decreasing? What's the cause of this? And what's the story behind it? Okay. So far about income statement. Excuse me. And now let's move on to the balance sheet. Balance sheet tells you a couple of different things. It has assets, and the next slide has liabilities and equity. Well, here, just to make sure everybody see it very clearly, we break it down into assets, and the other slide has liability and equity. Usually it is in the same table and in various different forms, but whatever the format it has, it will be starting from the amount of current assets. Okay, so the CA here, right here. How do I circle it? No, can I write on it? Yeah, the CA means current asset. Okay, so then it moves on to the fixed asset, the FA. Then the current asset and fixed asset will add up to the total assets. The current asset are the shorter term ones, less than 1 year, and the fixed asset is the longer term assets. Okay, so what's included in the current assets? Well, we have cash, apparently. You can use it anytime, that's why it's short term. And then what is this ST invest? Short-term investment, yes, very good. Yes, exactly. Then what's this AR?
Accounts receivable.
Accounts receivable. Okay, so for those of you who are not familiar with accounting or have a discount memory of accounting, the accounts receivable is because there is a discrepancy between the cash flow timing and the time that you are actually going to put it in your financial statement. Okay, so the financial statement, balance sheet, income statement, and all that is generated through what we call the accounting accrual. What does that mean? It means it doesn't really matter when you actually get the money. What it matters is when you economically have performed whatever activity behind the cash flow. Okay, so for example, if there's cash outflow, it doesn't really matter when you are paying out. What it matters is when you are conducting the activity that leads you to pay out that money. So say if you have hired someone, you could delay paying them their salary for 1 year, but the moment that they finish their job, that should be the time that you expense their salary on your statement. Okay, so same story. If you're going to receive something, say you have sold some material or some or provided service to your customers, and it doesn't really matter when you get their money. It should be recorded as your earning or revenue the moment that you actually sold it, had the agreement, or provided the service to them. Does that make sense? So basically, here is once you sold it to them, or once you provide the service to them, it has become the money that you officially earned, but may or may not be actually earned, and that is what we called the accounts receivable. In a sense, people owe you money, in one word. Okay, so accounts receivable is stuff or the money that people owe you that you do expect to be able to collect within a relatively short time frame. So that's why we keep it in the current assets. It should be something that you expect to collect within a year. Okay. So why is the inventory in the current asset?
It's short term.
It's short term. How would you guarantee it's short term?
A year or less.
Yeah, so ideally, in normal sense, that the moment you produce some kind of some kind of products and things, you put it on the side as an inventory, you should be able to sell it pretty fast, right? But it doesn't actually always happen. Okay, and that's why if you go to the second level or even the first level of CFA, it will be a lot of things about how you account for those inventories. Is it FIFO, the first in, first out, or is it the LIFO, the last in, first out? And switching between the two standards a lot of time will affect the bottom line and will affect how much inventory you have on hand and how much of this, how much of the cost of goods sold that you could actually incur. So if in that case, for those of you who understand of what's LIFO and FIFO, in that case, if we come back and look at this cost of goods sold, that huge jump over here, okay, you start suspecting, well, is it because the actual cost of goods sold going really way up, or is it because of the LIFO, FIFO accounting that kind of eat into the historical inventory that makes the inventory cost a lot higher than usual? Well, I'm just throwing this out there. Okay, so the inventory, after the inventory, we put all of these together and take that as the total current asset. Now, among these three different items in the total asset, which ones are related to operations and which one is not? I repeat the question. Okay, so let me ask it here. Which one of these cannot type 4 items is not related to operations? Yeah. Okay. So the fastest students come in and say yes, short-term investment. Very good. Okay, so the cash accounts receivable and inventories, all of these three are related to operations, and the short-term investments are not related to operational investments. That's why later on, whenever we talk about the operational assets, you should carve out the part of the short-term investment, because yeah, that is your money, that is your asset. However, it's not related to your main business. And again, the focus of when you look at a corporation is that you want to look at their main business. Well, now it's a different story when you look at a financial statement of a hedge fund, say, because their main business is for investment. So when they report to you short-term investment and a long-term investment, it means different things. Okay, it's talking about their strategies and how they divide it into short-term funds and long-term funds and all that beautiful stuff. Okay, and you can see the difference between industries. And this is where you really need to think very hard about the judgment. Okay, so why do we want to focus on the operational part instead of investment part? Anybody have any thoughts? Corporation performance. Because we have more control over operations, because the corporation have more control over operations. They should have control over investments too, especially the short-term ones. So if they are investing in some kind of stocks and indices for investment purpose, is it because, Tracy said, is it because it's fixed asset not used in operations? The fixed assets should be used in operations. But I'm not saying the fixed asset is not included in operational asset. I'm just saying the part that's about the investment is not included in operational assets. So there are a part of fixed asset used in the operations, and therefore it should count towards the operational asset. Okay, so Naomi said, is it because we are able to get a better picture on how management are handling the corporation business? Yes, that's partially true. To measure the operational cash flow parts, well, think about it. If you are an investor, what are you doing? You're putting your money into that business, hoping that the business could somehow have access to some kind of very nice profitable projects like Steve Jobs used to turn out the iPhones. That's a cash cow. It may or may not be a cash cow anymore. Right, so if you want those, do you want those firms to actually use your money to invest in other securities? Yeah, it depends on how risk averse the company is, right? So my argument is that if I want them to really invest my money into other kind of investment, I might as well look at some professional ones. Say, I might as well look at a fund, a mutual fund, a hedge fund, some kind of index, or even I would directly invest in some kind of security by myself. I can buy a bond, I can buy a stock. Why would I want you to do that for me? I mean, seriously, you are not a hedge fund, you are not a mutual fund, you are not any kind of fund whose main purpose is to help people invest their money, right? So that's not your main business. If it's not your main business, means that you probably don't have that much of expertise in it. And second of all, you're not investing in that, you're not competing in that category. Okay, I would highly doubt that you have the high power of a hedge fund or somebody who's performing very well in a trading desk in Bank of America, for example, or Goldman Sachs, to really satisfy my need for investment. Does that make sense? That everybody got what I'm trying to argue? Okay, so I would rather invest all my money in a company who is really able to do their job. Namely, if I invest my money in Apple, .inc or .corp, okay, I'm not trying to ask them to invest my money into, say, fixed income fund or hedge fund or something. I want them to turn out profitable iPhones. and that I invest in them because I think the kind of exclusive access or the exclusive power that they can operate some very profitable project that can generate the value added to my investment. Okay, so that is exactly why whenever we look at a firm's business or balance sheet income statement, we don't really want to see that their main income is from investments. We want to see that their main income is from operational stuff. Okay, so we want to see that they're doing very well in their main business and their focus is on their main business. Okay, so with that said, we of course have more stuff to the operational part. There is in the gross fixed income, fixed asset, sorry, and then less the depreciation. Okay, so what is the depreciation? 146,200 for 2012. Okay, come back and look at the income statement. It also has a depreciation of 18900. You're like, wait a second. That's a different number, right? Everybody see that? Look at this one. That's a depreciation in 2012. And then this is a depreciation that you subtract from the fixed asset. That's also in 2012. Okay, very good, Ahmad. Okay, on balance sheet, yes, this is actually the accumulated depreciation expense over the years. So namely, over the years, how much have you counted in towards the depreciation? Okay, so then this depreciation in the previous 18900, okay, that is the depreciation that has incurred specifically during year 2012. Okay, namely, these are slightly different concepts if you compare it. That's why they're different. So next year, you will actually see that this 18900 to be added to the depreciation here. Okay, that should result in the depreciation of 2013, which is not the case, and I don't have any clue why. Bao, why is that? I was asking you, okay, I thought that in the income statement, when we see the depreciation of 18900, you add that to the depreciation of 146,200 in the balance sheet. That should result in the 2013 depreciation, but that is not the case.
They might have acquired new depreciation.
Okay, very good.
Or like new fixed asset.
Well, that explains it. Oh, that's true. Okay, you got me. Okay, so then let's look at the net fixed assets. That should be the gross fixed asset minus the accumulated depreciation, if you will. That you got 344,800, and the total asset is at the bottom line. So now we again compare the 2 years and try to make sense of it, and because we kind of want to take a break in short little bit, let's move on to the liability and equity part, 2012, 2013. And for the liability, it also broke down into the short-term ones that are kind of related to the partially related to the operational part and partially related to the investment part. And we have the longer term ones. So here, the long-term debt is apparently related to investment or kind of investment income, or you're not really investing, right? You're kind of raising the money, but it's definitely not related to operations. Now, within the three items in the total in the current liability, the top three items, which one is not related to operations? Which one in CL is not related to liability? Oh, not related to investment. Really? Well, I'm talking about current liability. Accruals. Everybody agree on accruals? I thought it's notes payable, no? The notes payable are the amount of the medium-term notes that you have to pay back. Remember, for the fixed income, you have short-term bills, medium-term notes, and long-term bonds or long-term debt. So the notes is a part of the debt. Everybody agree with me? Right? So what is accrual? People, come on. What is accrual? Oh, Bao, go ahead. Go ahead, Bao.
Yeah, service provided but not paid. That's correct.
Right. So that's, again, the accounting, according to the accounting accrual, is basically the discrepancy between the cash flow timing and your actual activity. And if we are talking about the services, right, so it's revenue earned but not recorded yet, it's more like it's more related, still related to the operational activity, right? So I think in the current liability, the accrual, okay, service or revenue provided that's not recorded yet, okay, and then the accounts payable is pretty much means that you owe somebody some money that you're gonna pay them in a short while, and those two are related into operationals. And notes payable is not related, is we call it investment related, but it's not an actual investment, kind of like a reverse investment, if you will. Okay, so with that, with long-term debt, you have all the liabilities. Then you move on to the equity part. So the part that starts with common stock, retained earnings, and those two items are the equity. So the total equity is if you add common stock and retained earnings. Now, what is retained earnings? Yes, Tejas, go ahead.
So basically, after paying a dividend, company will keep some earning into with them, and that's called retained earning.
Yeah, exactly. So basically, think about every period, yeah, earnings not paid out as dividends. So every period after you do your business, you got your cash flow, expense everything, put it in all in together in the income statement, you figure out your profit, net income, or earnings. And these three means the same thing. And don't ask me why, just people crazy. So you have net income, earnings, or profit that is not paid out. Well, you can choose to pay partial part of it out, or you can choose to pay the whole thing out. Actually, for some kind of securities, for example, real estate investment trust, they have to pay the whole thing out as dividend. That's another story. But here, if it's not paid out, you got to keep them. Why do you want to keep them? Because you try to grow the business, try to reinvest them. and try to put it back as part of your corporation's value. And that part is what we call the retained earnings. Once you understand that earnings is equal to net income, is equal to profit, it's pretty obvious what retained earnings really means. Okay, so the part that you are not paid out as dividend, that you retained in your business, it's retained earnings. So with common stock, that belongs to the equity holders. And apparently the retained earnings is what the holders, the owner of the company has accrued as value, should also be a part of the equity. So these two added together is the total equity. Okay, so then you add the total liability and equity together, and every single accountant will tell you to make sure that the total asset is equal to the total liability and equity. Otherwise, you would not pass the auditing for sure. Okay, so with that, let's take a 10 minutes break. I found myself getting very excited because I don't have to stand all the time. I can go a longer session without breaking, but still, for my sanity, let me take a break for 10 minutes and stop talking for a little bit. Okay, so what do I do here? Temporarily stop recording.